In a liquidity crisis, anything and everything gets sold. You saw a little bit of that last week, where Bitcoin's down, stocks are down, gold's down, platinum's down, silver's getting crushed, everything's going down at once. This is a playbook that's not going to surprise many people. So the Fed's going to go to QEs, or gold might have a little hiccup as it's sold for liquidity, and then you'll never see those prices again.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Black Friday specials for November 24th through December 1st, 2025, while supplies last. This week, US 90% constitutional dimes and quarters are priced at spot. That's right, no premium whatsoever. And it gets better. When you buy $500 face value or more in a single order, it's 50 cents under spot per ounce. That's right, $500 face value bags or larger get you a premium of 50 cents under spot per ounce. We also have great deals on silver eagles, other silver coins and silver bullion, as well as gold, platinum, and palladium. Call us for the rest of our Black Friday specials, as well as any of the other many options we have available at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm always glad to have this returning guest. Michael Pento is the founder of Pento Portfolio Strategies. He's an active money manager. He joins us this Monday, November 24th, 2025. Michael, thank you for coming back on Liberty and Finance.
Always great to see you, Dunnigan.
And a happy Thanksgiving week to you and to your family.
Thank you. To you as well.
And to all of our viewers and subscribers out there, happy Thanksgiving week to all of you. Michael, we have you on for many reasons, one of which is your forward-looking view as an active money manager of the direction you see things heading and the internal metrics and forward leading indicators that you keep an eye on to keep your clients on the right side of things. It can be so complex and the countercurrents so strong that it's daunting for most people to even have the slightest inclination of which way things are heading, other than this vague sense of ill at ease that we're kind of on borrowed time, or that we have forces that may be unnatural that are buoying things up at the moment. Can you talk to us about what you're watching most closely right now and the big picture as we head into the end here of fourth quarter of the way you see things heading?
Well, I did take down some risk in the portfolio very recently. Over the past 2 weeks, I've reduced risk. So just to refresh you and your audience's memory, I was bearish at the start of this year, primarily because valuations were not only off the charts, but they were the market as a whole was entering a period of time where I would see growth slow. And that was primarily because of the border closures. So you'd have half of the input to GDP was going away. So I was bearish, not overly bearish, but it was negative, net negative on the market at the start of the year. And that was borne out, after April 2nd, and then I turned bullish in May. So I've been bullish in the market from May until 2 weeks ago. I'm getting there. Just I have to give you a little bit of a rope here to hang myself. So, as they say, so I'm now, much more bearish than I was before when I last came on your program. I think I was 40% long, and now I'm only about 15% long. So I'm not saying that the world is going into a global liquidity crisis or we're having a crash in the markets. What I am saying, what my model is telling me to do, is to become a little more cautious, even though, this is the bad time of the year to do that. November, December, some of the best months of the year, calendar speaking. So let me just tell you what. So beyond the obvious, where we see high beta sections of the market crash. So you think about, the AI trade, Bitcoin, some of the more speculative metals that saw a lot of flows in, they've all corrected sharply. In fact, I think Bitcoin is down 30% now from its high, and down about 7% on the year. So it's pretty significant. So beyond the fact that the market is telling me that there's some liquid stress in the high beta sections of the market, then I ask myself, I turn to my model and say, is this a correction which should be bought? Or is this something that I might have to worry about? So let me just tell you four things that I think that there could, I'm not, now again, let me caveat, I'm not saying sell everything. Michael Pento is now panicked about a credit crisis and a recession. Didn't say that. I said it's prudent to take some risk off the table. I'll tell you some things that I'm worried about. So number one is the yen carry trade is under a lot of pressure. I think I'm one of the one or two people that's even talking about this, but just to quickly refresh your memory and your audience's memory, yen carry trade, you borrow in yen for 0%, and then you go out around the world and say, sell the yen, buy other currencies, and buy their bonds, and it's like a risk-free. You buy their sovereign debt. Like the U.S. is yielding 5%, and the yen is the JGBs are yielding 0. And you pocket 5%. Then you have the currency translation and all that whatnot. But it's a free trade, and you lever that trade up many times over, and that money goes into the bonds, it goes into the stocks, it goes into dividend stocks of domestic equities. So you understand. So, and then what happened is that the Bank of Japan unleashed a massive stimulus plan. And the administration of Japan, the new prime minister of Japan, I'm not gonna pretend that I can say her name actually. I'm not even gonna try. But anyway, the point is that the yields in Japan started to rise. The benchmark treasury went from near 0. It was 0 for a very, very long time. Went from 0 to 1.8%. So, and our bond yields are coming down, or at least staying pretty much where they are. So, on the not the short end, on the long end. So you're having a compression in that trade. So that's pressure on the yen carry trade, and that less liquidity in the market. Then you look at the reverse repo facility, which was once $2.5 trillion. It's now effectively 0. That's the excess liquidity. Think of that excess reserves the banks don't need. They park it at the Fed. That's all been taken out of the Fed. It was laying fallow at the Fed, that credit, and went into the bond market. And that, that's it was like a QE. But that's over now. That's done. Then I look at bank reserves, the actual bank reserves in the system. That is down $1.2 trillion from where it was in 2021. Those are banking reserves. And then, finally, the fourth thing is I look at the real Fed funds rate, which for the last 2.5 years has been in positive territory. And just going back to the last couple of recessions, whenever you see a positive, and please don't write me letters. I mean, I understand they lie about inflation, but at least it's keeping the metric consistent. If you subtract the real Fed funds rate from inflation, you're at a positive level. And that's and just using their bogus methodology going back decades of how they measure inflation. And the Fed funds rate is obviously just, you can't lie about that. It's what it is what it is. So for those 4 reasons, I've witnessed in my model, financial conditions stop tightening, and that makes me believe that there's a real issue here. It could be the incipient, the very very beginning start of could be a credit crisis, but at least it's a significant enough liquidity drain for secular reasons that I need to protect my clients. So if you look at high yield spreads, you look at financial conditions, they're making me get a little more defensive in the portfolio. Sorry for the long answer, but that's the whole picture.
No, that's exactly where I was hoping you would go, is give us a high level sneak peek behind the magic curtain of these leading indicators that you've been tracking, because you've been talking about some of these things with us for some time. The yen carry trade unwinding is a big deal. If you look at the scope and scale of that, and the duration of time and the dollar values that are involved there, this artificial flooding of liquidity that has been used. Can you talk to us about what those funds have been used to do what people have been using that free money, free currency to do. And now if that's being withdrawn because it starts to be expensive to do that.
You think about the shadow banking system and hedge funds, institutions, things like that. They borrow, like I said, they borrow yen for next to nothing. Well, that was the tradition. And they had 400 or 500 basis points of pretty much guaranteed. I mean, if you're yielding 0% in Japan, so your cost of funds is zero, then you buy a U.S. Treasury yielding 5%. And you lever that up, 10, 20, or 100 times. That depends on what you can borrow from that. And you buy bonds and you buy stocks too. Maybe if your cost of funds is zero, you could buy dividend yielding stocks. And if you're comfortable with the trade, you'd think the yen is going to fall because that's the process, right? You're selling yen and you're buying other currencies. So the yen tends to fall in value. So you're not only getting the appreciation of the income and dividends from your investments, say in America or Brazil, whatever, but you also have the appreciation of your local currency. So your yen that you're buying back has gone down in value. You understand, right? Do you follow? So it's a win-win-win-win-win. It's a wonderful, almost risk-free trade, and that is ending now because now that you have currency hedging that's just gotten very expensive, and the margin that you had to play with is no longer 5%. It's 2%. And that's very low. So I'm not saying the yen carry trade is over. I'm saying there's pressure there. That's all I'm saying. And it's one of the 4 reasons why I'm starting to see financial conditions stop easing. Why I'm starting to see credit spreads start this is incipient now. That me being a nervous Nelly, I don't like losing money. So if it was just that Bitcoin was crashing and couldn't catch a bid, and AI stocks were falling, I would say, well, maybe this is just a healthy correction that should be bought. But then when you marry that with the 4 things I just mentioned and its effect on liquidity, and you say, well, wait, this could be systemic. This is something that I have to protect my clients from, just in case it turns out to be what I think is coming anyway, eventually.
One of the things you did not mention in your list of reasons for caution, reasons for concern, was insider selling. We've seen record cash position ever in the history of Buffett being raised, and also in George Soros's investment hedge fund. And obviously it's like 6-1 or 7-1 insider selling this year by even those of the high-flying Magnificent Seven. Is that factoring in at all? Does insider trading factor into your model at all?
No. Well, because it doesn't, because it doesn't affect liquidity. So everybody who sells something, you got to buy on it's a buy and a sell and it's matched. So it's not, if the reverse repo facility is drained, that's fallow money. That's like a QE program. The yen carry trade, it's new money printed by the Bank of Japan. Bank reserves. The only way you can lower bank reserves is only two ways that I know that bank reserves can get drained is by quantitative tightening when the Fed does it, or if there's a demand for cash. People go to the bank and say, I need cash out. Well, that drains reserves from the banking system. Not a run on the bank, but bank runs drain reserves. Well, reserves are dropping. They're actually dropping pretty precipitously at the last I looked at it. They're only reported on a monthly basis. So, but their reserves are down, as I said, 1.2 trillion from the high. So, the real Fed funds rate being positive, it acts as a drain on liquidity because there's a real cost in borrowing new money. So that's why I don't listen, do I think it's inconsequential? No, it's an ancillary, function of this liquidity issue that you would see insider sell, but that doesn't directly affect liquidity. So the answer is
no, but that's where I was getting at, is from my previous lifetime of involvement in more active trading, and there's a reason why that came to an abrupt end at the GFC, which I've described to my audience in the past. But they talk about stocks being under accumulation or distribution, meaning between accumulation by the most strong hands, the deepest pockets, that kind of thing, and being sold out at low sentiment times by ordinary retail investors, versus the opposite, where you have those with the most information, the most forward knowledge, distributing their shares out, and the ordinary moms and pops and the pizza delivery boy and the shoe shine, everybody telling you stock tips and why these things are going to go on forever. Sometimes those sentiment meters accompany turning points in the overall market.
100% agree with you. In fact, my model is built it to detect when I would see the handful of the oligarchs, I'll call it the plutocracy, whatever. The people who actually run this planet, their insider buys and sells and shorts is what I want to know. I want to know what they're doing. That's what I built my model on. So I see their footprints before the moving average blather that you hear on CNBS. I mean, that's just, listen. Tell me what the second derivative of inflation is, and tell me what the growth is, and let me monitor my liquidity model, and I'll tell you where I think. I tell you if I think we have a problem or if we don't have a problem. I mean, if you have a liquidity crisis or a recession, you're going to have a big problem in the stock market because you're starting from a point where it's, 220% of GDP, which is total market cap of equities. So the valuations are, the fact that we're in a bubble is indisputable. It's not my opinion. It's an absolute fact. It's an absolute fact. I mean, if you look at every single metric that you want to look at, price to sales, Schiller PE, trailing PE ratio, 10-year PE ratio, total market cap of equities to GDP. I mentioned price to sales, risk premiums being negative. There's a myriad of metrics you can look at, and this is not just something that's expensive. It's incredibly, humongously expensive stock market. So this is gonna reconcile itself in a very dangerous way because you can't point to me one bubble in history that has bursted innocuously. It just doesn't happen.
Yeah, the legendary soft landing from bubble territory is what you're describing is not something that happens. You mentioned in passing there the drying up of the reverse repo facility. Is there any consequence of that you see happening? And there was even some brouhaha over the last 2 weeks about banks refusing to accept each other's collateral as trustworthy for overnight loan purposes. Any comments on that?
Well, yeah, I mean, that's the excess liquidity. It was, like I said, it was like a $2.5 trillion QE program that's been ongoing since 2022. Money leaving the Federal Reserve, laying foul of their earning interest, and then coming into the bond and stock market. It's over now. You can't, I mean, I don't know why anybody would ignore that. I don't know why everybody's not talking about it. Maybe they just don't understand it, but there's 4 reasons that let me know that liquidity is under pressure right now. Now, could that change? Could the Fed change? Fed could fix this all by a significant QE program right now. If they cut rates to 0 and started launching a QE program right now, that would probably fix the problem. Only if the long end of the bond market said that was okay, which is it's just no guarantee at all. But that's a potential. But it's 2.5 years of a real Fed funds rate. That's been the precursor and the progenitor of recession in the past. And we're there, right? We're here. We're knocking on the door right now. So as an active money manager, if I'm wrong and the Fed comes in with a bazooka again, I'll change my investment style. But even on a day when today, this interview is being recorded on the morning of the 24th, market's up huge. I think it's up over 1%. And here I'm the idiot out on a limb saying, I don't think this is something you should be buying. I think it's something you should be selling for all the reasons I just mentioned.
So you mentioned the term active money manager. That's how I introduced you in the beginning. Help people to contrast what you do as an active money manager versus what maybe 90+% of people who are counting on the performance of their portfolio through a standard retail investment advisor. When you drive up and down any town in the United States and you'll see the same 3 or 4 names on these chains, these retail investment advisors, and they've been following pretty much the same playbook for the last 40 years or so. What are they likely to be hearing? And how do you contrast with what they're likely to be hearing from their retail investment manager?
This is why it's the most over-leveraged and over-concentrated stock bubble, over-valued, over-leveraged, and over-invested stock bubble ever. Those are the parameters. Those are the 3 parameters that I use to define a bubble: massive overvaluation, over leverage, over concentration, over investment. And that's exactly what we see, where, like 7 stocks are a third or 40% of the entire average. And these people that you're talking about are they're not money managers per se, in the classic sense that I think of as someone who's an economist or a market strategist. They're just salespeople who just will take your age and your risk tolerance, have a myriad of models, and plug you into one that you like. But they'll tell you, if you ask them straightforward, they'll say, you cannot time the market. I cannot time the market. And therefore, you have to always be invested. Well, but I mean, I believe them when they say that. I don't believe they can time the market. I'm not saying I have perfect timing either, but I'm saying that my model will absolutely, has a very robust history of identifying bubbles and when they're about to burst. Not the day they burst, but around the time that they're bursting. Maybe that investment style worked at one time, maybe when the market was 80%, total value of the market was 80% of GDP, but not when it's 220% of GDP. You can't just buy and hold stocks like that, because over the next 10 years, you're likely to return zero, actually negative. And that's not linear. That's not every year you get 0, 0, 0, 0. It's, one year you get 5, one year you get 10, next year you get minus 50. And then you're climbing your way back. You have to climb 100% when you're down 50. So you'll have many, the standard deviation in your returns is going to be very, very wide. But maybe at the end of this decade, they'll say, see, the market came back or even. And I'm going to be like, well, yeah, but you're even after, just not in nominal terms, after inflation, you've gotten wiped out, and you could have avoided losing half of your money and crying in your soup for 5 years or 6 years or 10 years, whatever. In Japan, you cry in your soup for 35 years. And in China, you cried and you're still crying in your soup. So is it wonton, or what's the soup?
I don't know, but that must be the secret ingredient.
So I have no confidence. I think the laws of economics and markets and gravity are the same in China and Japan as they are in the United States. This reminds me of the massive bubble that Japan had in 1989. It took them 35 years to recover. And they're a disaster over there. It's absolute disaster. They're actually, insolvent nations trying to shove more credit down the throats of the bond market and of the investing public. And I think the Japanese central banks have to buy all that too. And then you have inflation in Japan, which is already at 3%. So, as I mentioned, the 10-year note is 1.8. If inflation's 3 and it's going higher, your 10-year note should be at 3 at a minimum. That would wipe out the yen carry trade completely, especially when you factor in currency hedging. So watch out. I hope people don't come away from this conversation and say, again, Michael Pento has predicted the end of the world. I'm saying that there's an incipient liquidity issue. It could be secular, protracted in nature. I'm getting more defensive now. That's all I said. Okay, and I'm still not net short. By the way, I'm still not net short the portfolio. I'm still long 15%, but I've got lots of hedges. I've got precious metals in there. I'm shorted the long end of the bond market because I don't see any I don't see any upside from here. Upside in prices and downside in yield. I don't see it unless outside of a recession. And even then, I'm gonna tell you that even in a recession, that long-term bond yield probably is going to go much higher, because who's going to buy $6 trillion of an annual deficit? Who's going to do it? I guess the Fed's going to have to do it all. And then you're talking about risking inflation running intractable. And that would also be really bad for long-term bond yields.
Michael, for people who would like to find out more about taking advantage of your services as an active money manager, how should they find out more?
The website is pentoport.com. And if you have $100,000 to invest and you are qualified for a long-term, a long-short portfolio, so I will take you as a direct client. And you also can, for $50 a year, get $50 a year, get access to my podcast, The Midweek Reality Check, where you get lots of good takes on the economic data, if there is economic data to talk about. There should be some shortly now that the government's back open. And I'll give you a 36,000 foot view of what's going on with my portfolio. I won't give you exact, ticker symbols and sizing, but I'll let you know when I think this is something you need to be really, really concerned about. And sure, no, there will come a time, I can promise you this, that I will be in cash, short-term U.S. Treasuries, U.S. dollar, and shorts, the four horsemen of the economic apocalypse, and waiting for my opportunity to jump into gold with both hands and feet, because I think, just to end on this note, in a liquidity crisis, everything goes to a correlation of 1. R squared goes to 1. And anything and everything gets sold. You saw a little bit of that last week, where Bitcoin's down, the stocks are down, gold's down, platinum's down, silver's getting crushed. Everything is going down at once. But I think everybody's on to, and this is a playbook that's not going to surprise many people. So the Fed's going to go to QEs, or gold might have a little hiccup as it's sold for liquidity, and then you'll never see those prices again.
Michael, we're always grateful for your presence here and on just keeping us looking forward and knowing how to see what we otherwise might not be able to see. That's very helpful. And on behalf of all of our viewers and subscribers, I just thank you once again for taking the time to join us here on Liberty and Finance.
God bless you all, and have a happy and safe Thanksgiving.
Happy and safe and blessed Thanksgiving to everyone and all your families. Thank you, Michael.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Black Friday specials for November 24th through December 1st, 2025, while supplies last. This week, US 90% constitutional dimes and quarters are priced at spot. That's right, no premium whatsoever. And it gets better. When you buy $500 face value or more in a single order, it's 50 cents under spot per ounce. That's right, $500 face value bags or larger get you a premium of 50 cents under spot per ounce. We also have great deals on silver eagles, other silver coins and silver bullion, as well as gold, platinum, and palladium. Call us for the rest of our Black Friday specials, as well as any of the other many options we have available at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.